to the series of lectures which introduces the basic concepts of economics. My name is Shishir Sindekar, working with B.Y.K.College of Commerce as a teacher for the last 25 years. My areas of interest are economics and banking. My today's topic is marginal efficiency of capital and investment decision. My first question goes with the simple question. Investment decisions. The first question starts from why to invest, where to invest, and how long we are going to invest. For the first question, why to invest? So naturally, everyone will say that I would like to have a stable return, or someone will say no, I would like to have a windfall gain, or someone will say no, I am investing for my better future. Now there are different options available with us where to invest. I can start my own shop, or I can start my own factory, or I would like to have a better education and I would like to work somewhere else for someone, or someone will say I will invest in share market. I would like to invest in different kinds of shares or bonds or some other avenues because the share prices are rising. Or someone will say no, I will invest in gold where I can have an assured returns. So there are number of avenues, number of possibilities are available for investment. So the decisions related to the investments are very difficult. And for how long period we are going to invest, and we may expect that after how long, after what period we can get back the returns. So before going to that decision, how an individual would like to find out an answer, how a private firm would like to find out an answer for the same, and how the government is going to take the decisions about it. Again, I must say that if someone provides you 10 lakhs of rupees or 1 crore and asks you to invest somewhere, then someone will say that okay, I have observed XYZ shop which runs very good. He might be earning huge profit, maybe of say grocery shop, or maybe a jewelry shop, or maybe some other shop. So I would like to go with that kind of investment. So I would like to start a business. I would like to open a shop. So it depends on the history also. At the same time, there are some basic calculations on which the decisions are based. So this is very simple thing. I know that although it is very difficult, but it is rather simple than for the government. That how the government thinks about that investment, that is also an interesting part. Marginal efficiency of capital and investment decision is actually, my today's topic is actually a part and parcel of Keynes theory. John Maynard Keynes, who is a well-known economist who has changed the economic theories by just 360 degrees or 180 degrees, a complete turnaround. So what exactly that theory tells us about how the decisions are taken? So let me come to the Keynes theory. What he has stated? He has stated the Keynes theory is actually propounded to determine the aggregate income or total output, which also that theory also determines the total level of employment, and that is related with aggregate demand. So if the demand increases, naturally output may increase, and after that output is related with the employment. So this theory actually explains the total employment, total output, and so on. So he has stated that aggregate demand is nothing but a combination of three factors. Which are those three factors? The first First one is consumption. Second one is investment, consumption expenditure. Second is investment. And the third one is government tax, government expenditure. So we have ideas about the consumption expenditure. Our consumption expenditure depends on our income and propensity to consume, how we spend. Some people may spend 100%, some people may spend 20% or 50%. So my consumption is basically depends on my income and my propensity to consume. And Keynes has also explained the psychological law of consumption. Today, I am more interested to concentrate on investment. So that is the second part of the Keynes theory, that what are the factors which determines the investment. And he simply stated that marginal efficiency of capital, MEC, marginal efficiency of capital, and rate of interest determines the total investment that will take in that economy. Right now I am considering the economy as a whole, that is macroeconomy. So investment will take place if marginal efficiency of capital is more than the rate of interest. So this is the very simple solution he has provided, that if the marginal efficiency of capital in that economy is more than the rate of interest, then naturally more investment will take place. Now again the question arises that what do we mean by marginal efficiency of capital? How to find out it? Okay, so the simple answer that marginal efficiency of capital is that rate of discount which equates the present value of prospective yield from the capital asset to its supply price. Okay, somewhat appears as a somewhat difficult thing. Let me explain it in a very simple term. That today there is an entrepreneur, industrialist who invests rupees 10,000 to purchase a new machine. Okay, so assuming he is having all the other things, so he invests 10,000 rupees, that is the fresh investment on that machine. Further, we assume that new capital asset continues to produce goods over a long period of time, maybe for 20 years or 30 years, like that. And the net return, what exactly is going to get back, excluding meeting all expenses, except the interest cost, then the machine is expected, it is expected that the machine will produce the goods equivalent to rupees 1,000 per year. So in the first year, the industrialist will get back 1,000 rupees. In the second year, he will get again 1,000 rupees. Third year, he will get back again 10,000 rupees. In this way, he is going to earn the returns from that investment of rupees 10,000. So in simple mathematics, we can say the rate of return on capital is 10%. Rate of return on capital is 10%. But now I would like to switch over to the more efficient concept, that is marginal efficiency of capital. Let me come back to that concept. It is that rate of discount. So there is a basic difference between rate of interest and rate of discount. So marginal rate of efficiency of capital is that rate of discount which equates the present value, Here come back to this question, that present value of prospective yield, that what I am going to earn, rupees 1,000 in first year, 1,000 in second year, again in every year I am going to earn rupees 1,000. So that is actually the prospective yield from my capital asset, and what is the today's price, supply price of that capital asset, that we are going to equate. So again, let me complete it, or I would like to explain it further. The question is very simple. Whether the amount invested today by that entrepreneur is rupees 10,000 will have the same value recovered in next 10 years. So even after 10 years, he will get back the 10,000 rupees. But do you assume, do you feel, do you think that today he has invested 10,000 and after 10 years or in the span of 10 years is going to get back that 10,000. So value of that 10,000 and value of today's 10,000, whether will it be same or different? Definitely the answer is no. The amount which I am going to earn, 1,000 in first year, 1,000 in next year, 1,000 in third year. So definitely that value of 1,000 will go down and down and down. So the value of that money will decrease. The value of that rupees 1,000 will decrease. And today I am investing 10,000, and after 10 years, every year I am going to get 1,000, but the value of 10,000 which I am going to earn in the span of 10,000 definitely differs. It must be less than today's price of 10,000. So MEC, marginal efficiency of capital, is that rate of discount which equates my today's 10,000 with whatever I am going to earn in coming years. So that is an idea of MEC. So that will give me the rate of discount, and that is nothing but the marginal efficiency of capital. Now let me come to the specific formula of that. So what does that formula state? To the left hand we have seen SPC. So SPC means supply price of capital. Here we have assumed that it is rupees 10,000. Okay. So today's price of supply price of capital is 10,000. That is equivalent to Y1 divided by 1 plus R. So what is that Y1? Y1 is 1,000 which I am going to earn in the first year. And R is nothing but the marginal efficiency of capital, which I don't know. I want to find out that R. Plus Y2. What is that Y2? Again, in the next second year, I am going to earn rupees 1,000. And so on. And so on. So in the plus Y3 divided by 1 plus R raised to 3, or next is Y3 divided by 1 plus R raised to 3, and so on. So this is a mathematical equation which provides me the idea of marginal efficiency of capital. Here I know that how much amount of money which I am going to earn, 1,000 plus 1,000 plus 1,000 and so on. If the say the life of machine is 20 years, I can continue it with that 20. That means N is nothing but 20. So Y1 is 1,000 divided by 1 plus R plus Y2 is means 1,000 divided by 1 plus R2, R square, and so on. So in this way, I know the value of Y1 to Yn. I know the value of supply price of capital, that is 10,000, and then I have to find out the value of R, that is marginal efficiency of capital. So in this way, I can find out the marginal efficiency of capital. So that means it is a rate of discount which is going to equate my today's supply price of capital with my prospective yields, prospective returns, and that is nothing but the marginal efficiency of capital. I hope that this explains, or in nutshell, I would like to say the value of coming revenue every year is different from the today's value of investment. So this is a basic idea about the marginal efficiency of capital. So to make it more simple, I would like to say that there is one more thing which says that with every incremental increase of unit of capital, marginal efficiency of capital decreases. Remember that today I am investing 10,000 rupees, but that value of marginal efficiency of capital will go downwards. So it is the behavior of investment in respect of new investment depends upon the various stocks of capital available in the economy. That means as the stock of capital increases in the economy, the MEC goes on diminishing. Some investor invests 10,000 rupees today. Some investor invests 10,000 rupees again. The third investor or the same investor invests again 10,000 rupees again. So if he increases his investment, then that marginal efficiency of that capital goes on decreasing. So this is somewhat different. We are using the word capital and investment, but do remember capital is a stock concept and net addition to that stock is nothing but investment. So there is a little difference, so I am using it as same as it is. So in future also I will use the MEC concept, but if you learn Keynes theory in detail, then you will find out our MEC and MEI are different concepts, but for simplicity I am assuming that they are same. Okay, so when you are going to invest means net addition to the total stock of capital. So when you are going to add 10,000 rupees more, the rate of return is going to decrease. This is the observed values of MEC when we have studied number of investments and from number of companies and from number of countries also. This is an established fact that as you increase the stock of capital, naturally the MEC slowly decrease. Now imagine now if this is a question that MEC is declining, then at what point how much investment we have to make? And this is not for an individual. The government will also have to think on that how much investment they should make to create X value of jobs. Today we are observing a pandemic situation. Today we are observing corona, COVID, stress. As a result, the companies are not interested to increase their investment. In that case, the government will have to step up and government will have to increase the investment. They may invest in infrastructure, creation of roads or some other infrastructural facilities. But at how much investment can create how many jobs? That is a critical question, and that question can be answered with the help of this marginal efficiency of capital. So let me come back to our previous example. In that case, marginal efficiency of capital is say 10%. So an entrepreneur can get a return or rate of discount is 10%. So 10% for simplicity is say assuming that it is a rate of return. But at the same time, if he doesn't have his own capital, he will have to borrow it from the bank or some financial institution. He will have to borrow that capital from bank or financial institution, and the rate of interest which he is spending, it's at 12%. The rate of interest what he has to pay is 12%. Now imagine that he will have to borrow a capital at the rate of interest is 12% and the rate of return MEC is 10%. MEC is 10% and rate of interest is 12%. So naturally, if marginal efficiency of capital is less than the rate of interest, then the decision do not invest. The idea is very simple that MEC is less and rate of interest is more on which he is going to borrow, so this will never match. But if again imagine in this way that the rate of interest is 12% and marginal efficiency of capital is 20%, that is the rate of return, it said 20% is the rate of return, then naturally he would like to invest because rate of interest is less, so he can borrow at cheaper rate, he can invest in his industry and he can earn more profits. And so naturally, if the MEC is more than the rate of interest, then naturally the decision should be invest. So do invest if MEC is more than I. If MEC The marginal efficiency of capital is more than the rate of interest. Now, according to J.M.Keynes, this nation's output, employment depends on the stock of capital. Yes, definitely. If you have more capital, you can have more output. And that more output is related to more level of employment. And increase, so if I want to increase the employment, if I want to increase the output of the economy, I will have to increase the stock of capital. So, what will determine that stock of capital? Or how can increase that investment? So that decision will depend on marginal efficiency of capital and rate of interest. So again, I would like to bring one more thing, that right now I'm not going to discuss that what are the factors which determines the rate of interest. Keynes has provided a theory for that. What that theory states, it is called as, say, liquidity preference theory of interest. Supply of money and demand for money will determine the rate of interest. It's so simple. Supply is determined by the central bank of that country. In India, we can say Reserve Bank of India determines the rate of interest. Although I know that RBI has rate of interest are determined by the market forces, but still RBI provides the reference rate. So supply of money and demand for money determines the rate of interest. So in this way, the rate of interest and MEC, rate of interest and MEC will determine the investment. So let me come back to our original idea which Keynes has propounded, C plus I plus G. So consumption is one of the factors which definitely affects the aggregate demand, which is a main constituent of aggregate demand. Second thing, if consumption expenditure is not sufficient, today in pandemic period, people have lost their jobs, so they do not spend more. So consumption expenditure is less, then the investment can be more either by the private sector or by the government. So autonomous investment or other types of investment. So in this way, that investment decisions is basically determined by the MEC and rate of interest. So in this way, we can explain the idea of marginal efficiency of capital as well as the investment decisions. So here again I would like to make a conclusion, or say I would like to answer, or it will be possible for you to answer the few questions. The first thing, what do you mean by marginal efficiency of capital, and how MEC and rate of interest determines the investment decisions? So in brief nutshell, I have tried to explain the MEC, concept of marginal efficiency of capital, as well as investment decisions. If you have any doubt, you can directly contact me. I have provided my number and as well as the email ID also. So thank you very much, and hope that you must have understood this lecture. In the next lecture, I would like to come back with some new ideas and new basic economic concepts. Thank you very much again.